ACCA MOXIE students, my name is Neeraj Sain. I'm your ACCA trainer. I'm going to start the business valuation chapter. In this chapter, we will value the business, and for this valuation, we need to understand. So in this chapter, we value the businesses. So before we value, we have to understand that the mindset we have to keep in mind is very different than we have in our cost of capital. So in cost of capital, we have the mindset of a borrower. We have mindset of borrower. But here we have the mindset of, in business valuation, we have the mindset of investor. Okay, so here we borrow from equity, debt, and preference share. Here we invest in equity, debt, and preference share. Okay, so if we are a borrower, then we pay the dividend, we pay the interest and dividend. Okay, but here we receive the interest. Okay, here we receive, but here the formula for the cost of capital, like we have the formulas here in the cost of capital chapter. For example, if we need to calculate the cost of equity, then we have the formula here is D01 plus G divided P0. Okay, this is the market price. Okay, but here in business valuation, when we calculate the business value, then we have to calculate this P0. Okay, and we are given with this KE. We are given, and we have here G as well, so we will deduct G here. Okay, so here we have to calculate the cost of equity, but here we have to calculate the price, that is the market price of the share. So here we have price given, but here we have the cost of equity is given, and we have to calculate the market price of the share. So it is the opposite of the cost of capital chapter. So business valuation is inverse of the business valuation. Okay, so now we have to value the business, and there are another concept, that is market efficiency. It is how a market is, how efficient a market is. Is it inefficient, efficient, or is the level of efficiency, is it a weak form efficiency, semi-strong, or strong form? So all these we have to learn in this chapter. So we have to value the shares and the debt, and this is the another concept, we will understand this later. Okay, but let's first start with value of shares and the debt. In value of shares, we will solve it by, we will value by the asset based, we will value shares by income and the cash flow. Okay, we value with asset, income, or cash flow. Okay, in asset based method, we have book value, NRV, and replacement cost, and in the income based, we have the PE ratio and the earning yield method, PE method and earning yield. And also in the cash flow methods, in cash flow based, we have the dividend valuation method and the discounted cash flow method. Okay, so let's do, this is the whole overview of the chapter, that we are going to understand and calculate the value of the business. Okay, so but why we need to value a business? We need to value a business because we are going to invest. So because in the business valuation, we are the investor, so we are going to invest in some businesses, or we are buying someone business. So before you buying, you have to value that business, because is it worth investing in that business? So how much is it Is it the value of the business? So before you buy anything, you value that. If it is 70, if it is 70, should I pay above the 70, above the 70 or below the 70? Okay, this is the value, this is the value. But if the seller wants above the 70, should I give it 7 above the 70 or should I give lower than? Is it worth $70 or not? Okay, is it worth $70 or not? So we have, for this we have to calculate the valuation of that item of the business. Okay, this is the financial assets. So we can any business can sell the assets as well. So okay, a whole business or the assets. So there are several reasons for valuing business and financial assets as follows. So reasons are tax and legal and commercial reasons. So these are the three main reasons. For tax reasons, we need to calculate the valuation of a business. For legal reasons and the commercial reasons. For tax reasons, if you are getting an inheritance property, okay, if you are getting any inheritance property, then you have to value that property, because that property will be taxed according to inheritance law. Okay, so if in order to tax them, we have to calculate the inheritance property value. Or if you get any inheritance business, so if that business is valued, then we can only calculate the tax on that. Okay, so for the capital gain region, so for example, if you buy any shares at 70, but now the selling price is 100, so this difference is the profit. So this difference is profit and it is the capital gain. On that profit you have to pay the tax to the government. Okay, so another reason is the income tax. We need to value the business for the purpose of income tax we have to pay, and the financial assets. Right? Okay. For legal purpose, if business and financial assets are being used as collateral, loan collateral, if you are depositing, if you are collateral any business or any financial assets, if you are borrowing money from the bank, so they need to, if you are borrow money from the bank, your bank, and you have the business, so if you are borrow money from the bank, if you are borrowing, then you have to deposit security or the collateral. That collateral can be the any business or any assets. So before the bank give you money, that bank will value that asset or business. If it is giving 100,000 to your business, so if this business is valued 100,000, then he can only give you money. But if this business is, if for example, if this asset is only 70,000, then 700,000, then it cannot give you money. The bank cannot give you 100,000 because the asset is only 700,000, 700 only. So if the asset is only 700, then why the bank give you money and make a loss of 300? Okay, so the bank will only give you money if the value of the asset is at least 100,000 or above. Okay, so that if you don't pay, in case of non-payment, the bank can recover that money from the selling the asset or your business. Okay, next is the this is the one of the reason that we have to value the financial asset or the business. Okay, next is the to establish value of shareholders held by retiring directors. If any directors have the shares and they are retiring now, so they have to sell the shares, to the company, and and they have to sell the shares to the company, and that shares will be valued, and that shares will be revalued, or I can say that needs to be valued. So for this reasons we have to calculate the value. So we have to calculate the valuation of the shares that director. So we have to calculate the value of those shares that is held by the directors, and in proportion to that we have to pay the cash to the directors. Okay, and okay, next is the commercial reasons. If business and financial assets are being bought and sold, if you want to buy any financial asset or the business, if you want to invest in any financial asset or business, then you have to value, is it worth investing or not? Is it worth investing or not? So that your investment uh, do not make a loss. Okay, another is the takeover. When you take over any business, takeover means above 50%. If you take over any business, then you value the business, whether it is how much money you have to pay for the takeover. Okay, next is the merger. When you merge any business, you have to value that business. And if a business is being floated on the stock exchange, before the flotation of the stock exchange, before your business being listed on the stock exchange, you have to value the business. If a business is floated on a stock exchange, because before you list your shares on the stock exchange, your business must meet the threshold criteria, because only a business can list their shares on the stock exchange if it has a value above the threshold. So there is a minimum value that a business has before it is being listed on the stock exchange. So any business, so if it is a small business and you know that small business cannot be listed on the stock exchange because the valuation of these business are very low, so they cannot, so a business has to be well meet the threshold valuation criteria before it is being listed on the stock market. Okay, this is the most likely reason for performing valuation in this paper. Okay, so these are the mostly used reasons for your exam. A firm's market capitalization is found by market cap. What is market cap? Market cap is current share price multiplied by its number of shares. So it is called the market capitalization. However, this may not represent the appropriate figure for the purpose of business valuation. So can I say that the business is, this is the business valuation, this is the business value. So this is the business value. Can I say this is business value? No, because the share price is fluctuates frequently, because share price change frequently. So you cannot say that this market capitalization is the business value, because share price change frequently and it depends on many factors like bad news and behavioral finance. We will learn this uh, at the end of this chapter, and so many other factors. So it keeps on changing, so we cannot value the business based on share price. Next is not available for company that is not listed. So this share price is not available for unlisted companies, so we cannot list share price share price multiplied by number of shares if it is not a listed company. So we can only value the listed companies, but we cannot value the unlisted companies because they don't have the current share price. So also this is not useful for listed companies because the share price changes frequently. So we cannot use market capitalization as a base for valuing the business. Okay, so how can we now, the question is, how can we value the business then? We have to value the business based on their assets. So assets is the net assets. That is total assets minus the current liability minus the non-current liability. or I can say that these net assets are the shareholders fund, that is equity share capital plus reserve and surplus. So this is the shareholder fund, that is the net assets. Next is the book value. So book value is the historical value. It means it represent in the book value is value in books, that is our SOFP and our PL. Okay, so book value is the value in the books, accounting books. Okay, so and this value, you know that it is a historical value because SOFP is because we prepare these SOFP and PNL based on the transaction that happened during the year. So at the end of the year we prepare these statements. Okay, so it means these are the historical values. Okay, and does not represent the current market value. So does not represent current market value, yes. So next is the first, this method is the book value method. So this is the book value method and we can directly take our values from the SOFP and PL. Okay, next is the realizable value. Realizable value is generally better indication of the price that there will be a sell off or asset stripping. Okay, our realizable value would need to be given in the question, and this value, realizable value, has to be given in your questions. Okay, first you have given the SOFP, PL and the realizable value given in the sum in the notes. Okay, so why, how realizable value and market value is different? So market value is the buyer would pay. Okay, so market value is the market value is the amount a willing buyer would pay in an open market. Okay, buyer willing to pay in open market before it is any selling cost, before any selling cost. Okay, so that is the market value. But what is realizable value? Realizable value is the amount that is received by the seller, but received by the seller after deducting the selling cost, after selling price minus cost to sell. So that is realizable value for the seller. Okay, that is realizable value for the seller. So the realizable value is definitely the lower than the market value, and it has to be lower or higher than the book value, because book value is not is not the realizable value, because book value is the historical value. So for example, if the book value is given in the books, if book value is given in the books, so we are calculating through net assets. So if net assets are given in the sorry, the total assets are given 100, and we have the current assets, 20, and we have the non-current liability, that is 30. So the net assets then would be the 50. Okay, but in realizable value, can be these total assets can be lower, because some of our data don't pay our debt, because they but these total assets may not get realized in full, because some of our data will not pay. So these has to be deducted, that value has to be deducted in this. And if our machinery is a old machine and that cannot be sold at that price that is written in the books, so then that will be deducted from this amount as well. Okay, so might be that these total assets can only be realizable at, for example, 80 only. Okay, and for example, these liabilities are higher. So these liabilities are higher and these non-current liabilities are similar. Okay, same. So now our net assets will be different. Now our net assets will be different. So our net assets now will be 80 minus 25 minus 30. Okay, so our net assets now only 25. So you know that this realizable value and book value is different. So book value is from the SOFP and PNL, but realizable value is how much we can realize after selling the assets or after receiving money from the debtors. Okay, so these are the realizable value. Okay, so it might be that your liabilities can be higher than it is written in the books, or it can be lower, and your assets can be higher or lower. So that is the realizable value. It has to be given in your question. Okay, so next is the replacement. The method is same, but that the method is same, the net assets method, but the value you have to write is different. Okay, the value you have to take has to be different. So this one is the book value, this is the realizable value, and if replacement cost method is used for the calculation, then this has to be the replacement value. This has to be replacement value. And what is the replacement cost? Replacement cost is the value of same assets, is the value of same asset or same business. If you try to duplicate that same business, if you want to buy, if you, for example, if you have a plant and machinery, if you have a plant and machinery that is xyz company. So if you want to open if you want to buy same machinery, so how much does it cost in the market? So that is the replacement cost. Or if you have any business, if you want to duplicate, if you want to open the similar type of business, then how much does it cost to you? How much does it cost to you if you start same business, similar business from the scratch? So how much does it cost? So this is the replacement cost. Okay, next is the intangible assets. And while calculating all this net assets method, while calculating the net asset method, we don't consider intangible assets. We should ignore the intangible assets because the intangible assets cannot be realized. Okay, and that has to be, or it can be the self-generated assets like self-generated goodwill. So for the calculation, we don't consider this because nobody pay for your self-generated assets or your or how much is your how hard your employees work for your business. So you will definitely try to put value higher, but in the market they don't pay you as much as you show in your books. So these are based on your personal judgment. So definitely no one gonna buy or at that price, right? So the next is the, so for the calculation we should ignore this, but if you want to, but definitely the value that is the that is the final value that you pay or receive for your business if you are selling the business. So definitely it will be higher if you have the and goodwill, or if you have the good reputation in the business. But for the calculation we don't consider it here. Okay, so the final amount will be based on the negotiation. So based on the negotiation, not as good at valuing the ongoing earning profit potential of the business. So this method should not be, cannot be used for earning potential because it depends on the historical value and past values. So this cannot be used for valuing the ongoing earning potential of the business. Okay, investors do not normally buy a company for its statement of financial position. So investors usually don't buy the so generally the investors don't buy your business for the assets. So if they want to buy any asset, they can buy from the open market, they can buy from anyone else in the market, but they generally buy your business. So they buy your business because they see your business as a good, they see your business has a good potential in the future and they can earn good amount of money after buying your business. Okay, that's why they are considering to buy your business. So investors do not generally buy for the statement of financial position for the assets, but for the earning and cash flow for the future earnings that your assets can generate. So do not consider valuation of shares not shown on the statement of financial position, such as intangible assets and the value of future profits. Therefore, it is not useful for valuing service companies. So if you have a service companies, so in service companies you don't have much tangible assets. So they have the service company, they depends on the employees, they depends on the employees patent, mostly they depend on the employees patents and any formulas, or you have the specific recipe that depends. Okay, so often operate low intangible assets, like accountancy firms depend on the ACCA. If you have the high skilled ACCA employees, then your accountancy firm will be very high value. But if you but the accounting firms generally don't have many intangible assets. The only assets they have is the chairs and the laptops, and that's all. So for that, it is not good to value accountancy firms based on the net assets. So this method is useful for needs real estate or property companies. So because they have the tangible assets like building. Okay, so let's understand some of the advantage and disadvantage of all these three methods. So we have the book value, NRV, and the replacement cost method. Okay, so the advantage for book value is that it is relatively easy to obtain. So you can obtain these values from SOFP and PL, right? And the annual statement, you know that you can obtain these net assets value generally from the SOFP, statement of financial position. So the this can be obtained from SOFP. So it is relatively easy to obtain, right? So this is the advantage. And you know that these values, the assets and these liabilities are the over the years, these are the accumulation of the past performance. So these are the accumulation of past performance. So these are the accumulation of past performance. So these are the historical values. So historical values are not good for the decision of the future. So you cannot take decision of the future based on historical values. Okay, so this is the disadvantage. Although it could be fair value, which is less of a problem. Okay, that's not anything. Okay, next is the NRV. NRV is the minimum acceptable to the owners. Why it is minimum? Because the realizable value is what you can realize after deducting any bad debt or any anything that you cannot realize. So that is the realizable value. So definitely it is the lower than the book value. So this is the minimum that you can accept by selling your assets or the business. Okay, so another advantage is that it one advantage is that net asset method, the NRV method, in the net asset method, you can get the minimum value that you can accept. Okay, the another benefit is that it is used for asset stripping. Asset stripping is by low, by underperformed business at low low value and sell individual asset. Okay, so asset stripping is buying. If you in asset stripping, you target the underperformed business, you buy them, and then after that you sell the individual assets. And you know that in the net assets method, you individually value the assets and the liabilities. When you buy these assets and liabilities, when you buy these assets and liabilities from the low performing business, so it is already valued at the in the net asset method. When you already know the value of these assets that you bought from the previous business, then you can add some profit and then you can sell individual assets. So if you, for example, if you bought any assets, for example, these are the assets, that is plant and machinery. So you have the debtors. So now you can know that you bought it at 100, so you can sell it at 110. Or so this method is very useful in asset stripping. Okay, so because you already know how much value you bought, so you can easily sell at the higher value higher value of higher value by selling individual assets, because the valuation is already done by the previous companies. So this is one of the benefit. Next, the disadvantage for this is it is valuation problem, specifically if quick sale. If you want to sell your business quickly, if you want to sell your business in, for example, if 1 month, or if you want to sell your business in 15 days, let's say 15 days, if you want to sell in 15 days, or if you want to sell your business in 1 week or next day, then you cannot sell the business, because the valuation takes many days. For a big companies, the valuation may take 3 months or 4 months. So this is not useful for the big companies to sell the sell the business by the net assets method. Okay, so if you want to sell your business in 1 week, so it is not possible, because the valuation report, the you have to take the valuation report and calculate the other how much you can get from the data. So all these take time, and that cannot be easily done in 1 week, so it will take time. So this method is not useful if you want to sell your business. Or if you Next is the goodwill. Another disadvantage is that if you want to sell your business quickly, then you cannot get the same realizable value that you ordinary get in the normal days. So and the buyer knows that you are in hurry to sell your business, so definitely they will lower your business values, and your assets value. So it is not useful if you want to sell the, so your assets value will be very low or might be high if you want to sell it in. So next is the ignore goodwill. Ignore goodwill. So in net assets method, you don't consider the goodwill, and that this is the disadvantage, because the goodwill for the accountancy firm or the business that has like software companies, so they have the so they have the intangible assets, and they have the goodwill, for goodwill that cannot be, that cannot be realized, that cannot be considered in the net assets method. So what, this is one of the disadvantage. Okay, next is the replacement cost. Replacement cost is the how much, how much you can get if you want to, if you want to if you want to duplicate, if you want to duplicate similar business, how much does it cost? Okay, replacement cost is how much does it cost if you want to duplicate similar business or asset. If you want to duplicate similar business or asset, how much does it cost to you? So for example, if you have the plant and machinery, and you have done some modification in that, then that plant and machinery must be higher than the market value. If you done any, if you have any plant and machinery and have done any modification, then you will get the modification value in the replacement cost as well. So this is the maximum that the buyer can pay for that, for that asset. Okay, next is the valuation problem. Valuation problem is that this modified asset, this plant and machinery modified asset cannot be similar in the market, because you modify this plant and machinery, so it is hard to find the similar assets for comparison to value. So this is the another, this is the disadvantage of this method. Okay, so it also ignored the goodwill. We already know this is the disadvantage for all the methods in the dataset. Okay. Okay, let's solve this question. AJB company. AJB is an IT consultancy. IT consultancy is a service-based business. Okay, service-based business. IT consultancy based in Asia, which trades globally. Okay, it was established 10 years ago, so it is a old business. And you know that in service-based business, they are mostly have the employees, depend on employees. So service-based companies like IT consultancy depends on the employees. So they don't have the tangible assets. Instead, they have the intangible assets. Intangible assets like employee skill, like employees skill. Okay, so the four founding shareholders own 25% of the issued share capital each. Okay, they have the four founders and each hold 25%, okay, of the share capital. Okay, and are also executive directors, and they are the executive directors. It means that they are also running the companies as well. Okay, so the shareholders are considering a flotation of AJB on an Asian stock exchange, and has already started discussing the process and a value of the entity with the financial advisors. So now these directors and these founding shareholders, now they are considering, these shareholders are now considering flotation on the stock exchange. Means they are now considering the listing, they are now considering the list their shares on the stock exchange. So you know that this one of the reasons we have to value our business is the, when we list our shares on the stock exchange, then we have to value our business, because there is a minimum threshold that has to be met before it is listed on the stock exchange. So the minimum valuation depends on the country as well, depends on the specific countries. Okay, so before listing, we have to value our business, because only business whose value is higher than the threshold, then only they can be listed on the stock exchange. Okay, the four founding shareholders and many of the entities employees are technical experts. Okay, the founding shareholders, the founders and the employees, the founders and the employees are technical expert in IT, but they are not, however they are not however they are non-financial expert. So they don't know about financial accounting or finance business accounting. So they don't know about the finance non so they are technical experts, but they are not financial expert. So they are non-financial experts. Okay, so assume you are one of the AJB's financial advisors. So now the AJB has appointed you as their financial advisors to value the company, and you have been asked to estimate the value. Now you have to value that this company entity and explain your calculation. You have to calculate and explain this approach to the director. You have to calculate and then explain your approach to the directors. You have obtained the following information. You have the following information: summary of the financial data for the last 3 years and the forecasted for the next 2 years. Okay, so this is the current year and these are the future years. These two are the forecasted, and these are the past years. Okay, these are the forecasted and these are the past years. Okay, and this is the current year 20x3 stage. Next we have given the statement of financial position. The assets we have the non-current assets here, and 3 years past data is given, x1, x2 and x3. So we have the non-current assets, the property and equipment we have this, the non-current assets we have, and this is the total, and equity, share capital, retained profit and the current assets. Okay, we have all these past data given for the financial position. Okay, now we have also given the some notes here. So the book value is of the non-current assets are considered to be realizable values. So book value is realizable value. So these are the these so these values are the book values, but also these values are the realizable value. Okay, so we don't have any specific realizable values. The book value are also the realizable value as well. Okay, so the other information assumptions: growth in after tax cash flow for 2026. Okay, so the other information and the assumptions also given here. The growth in after-tax cash flow for 2026 and beyond. The cash flow for 20x3, x6 and beyond 20x6. Okay, and beyond is 2% per annum. Okay, and the cash operating cost can be assumed to remain the same percentage of revenue. Cash operating cost is same percentage of the revenue. Okay, so the depreciation is assumed to equal capital allowance. Depreciation is equal to capital allowance and remains constant from 20x6 onwards at 20x5 level. Capital expenditure can be assumed to equal depreciation, and the capital expenditure is equal to the depreciation. Okay, so the tax has been payable at 30% for the last 3 years, So tax paid at 30% from the last 3 years. This rate is expected to continue for the foreseeable future, and tax will be payable in the year in which the liability arises. Okay, the tax is expected to continue for foreseeable future, and tax will payable in the year in which liability arises. So same year you pay the tax. Okay. So next is a comparable company is AJB. So AJB, a comparable company to AJB, a comparable company we have identified is already listed, which is a listed company. Comparable company is a listed company which has a share price of this and the EPS is this. So can we calculate the PE ratio of comparable company? The PE ratio of comparable company is now 1.5 divide 0.5 equal the PE ratio of the comparable company is 15. Okay. Now an estimated cost of equity of the industry cost of equity is given, which is after tax. This is 11%. Calculate the asset based valuation of AJB and comment on your answer. Okay, so we have to calculate the valuation based on net asset. Okay, so how can you calculate? So you just need, how can we calculate? We can calculate by taking the total assets, and then here we have the only the current liability, we don't have the non-current liability. So we can, we can 170 minus 37, 170 minus 37, how much is 133. Okay, and we can also calculate this because net assets is also equal to net assets, or we can say that it is shareholder fund. Shareholder fund is 20 plus 113 equal 133. Okay, so now the solution, we have calculated 113 is the net assets. 113 is the net assets, and if you want to value per share, so we need to divide it by number of shares. So number of shares is 20 divided by 0.5 equal 40 million. 40 million is the number of shares, so we have to divide it by 40. So we will get value per share is 3.325. Okay, so this is the value, total value, and this is the value per share. Okay, so in this, the limitation is that we have not considered any intangible assets. So here the intangible assets is not included and it is not given, but if it is given then we should not include it. Okay, so the no account is taken of an intangible value, which is an IT consultancy. It is a IT consultancy, so it has intangible assets like employees, the efficient employees, which is not considered here. So this is one of the disadvantage of the net asset method. No account is taken of the intangible asset, which is like the motivation that's in intangibles and intellectual. While we are told that book value reflect realizable value, there is no indication as to when things like the non-current assets were last revalued. Okay, so these are the one of the, I mean, the drawbacks. Okay, next is we have income based methods. Now we have the income based methods in which we calculate the value based on the income of the company. So these methods are useful if valuing ongoing earning stream, ongoing business. We value the ongoing business streams with a view business carrying on. So we value business considering the business will continue in the future. Okay, so in the previous we consider that the business, we need to sell this business and the business will is not performing good, so we want to sell our business, and then we have to, like, we have to value that business in order to sell. Okay, or if you want to, list in the on the stock exchange, that was in the question. So, but here we are the going concern and our business is doing well, but we need to value our business based on the income. Okay, so if considering acquisition where a controlling stake is being considered, for example, if considering an acquisition where controlling stake are taken, since the acquirer will be in control of potential earning. Okay, so here we, if the question is telling you that we need to calculate the, we need to take the earning, we need to take the control over the business, and the business is a going concern and business is doing good in terms of earning, then we have to apply this method. Okay, so we need to calculate this. So income based method is useful for valuing the ongoing earning stream. Okay, so if there is an ongoing earning stream and we want to value that, so we can use the income based method, and the business is carrying on and we assume that this business will continue in the future. Okay, and also we are acquiring the controlling stake greater than 50%. Okay, so when we acquire the controlling stake in the ongoing business, so we have to use the income based method. And when we acquire the controlling stake, we acquire actually the potential earnings of the business. Okay, so in the income based methods we have two methods, which is income based, we have two methods. First one is P and the another one is earning yield. So earning yield is just the inverse or opposite of the P method. Okay, so P, what is P method? In this P method we take the P ratio. So P ratio is the price divided by the earning. So in numerator we will take the share price and in denominator we take the earning per share. Okay, when we divide we will get the P ratio. What does it P ratio mean? P ratio means how much the investors wants to pay for the earnings of the business. Okay, so in proportion to earning, how much the investors wants to pay for the business. Okay, so if the P ratio is higher, which means this based on the earnings they want to, if the earning is 10 and this is the 15, it means this is the 1.5 times, this is 150 times, 1.5 times, okay, sorry, times the PE ratio. So the investors wants to pay 1.5 times of the earning. So if the earning is 10, then investors can pay 15 dollar per share per earning, okay, of your earnings. Next, we have the value per share. In order to calculate the value per share, we have to multiply P by the earnings per share. Then we will get the value of our company. So this PE ratio, you know that when we take this PE ratio, this is for the listed company. So we take this PE ratio of our similar company. This P ratio is of the similar company as similar to our business, okay, and this is the listed company and our company is not listed, so we will take the P ratio of that company and multiply it by our earning per share, then we will get the value per share. But if you want to total value of the company, if you want to calculate the total value of the company, then you have to multiply P by the total earning, you will get the total value of the company. So PE ratio are only available for quoted company. So PE ratio only available for quoting companies. So if you want to value the non-listed, non-quoted company, then you have to use the similar quoted company business. So use and adjust if necessary. So why the adjustment is necessary? Because this PE ratio is higher. Because this PE ratio is higher than our unlisted company because of marketability. Because of marketability of the shares in the listed company, the investors pay the higher price for getting the one for getting the earning per share. Okay, so we need to adjust this before we use in our company, if our in our company to find the value. Okay, so what are the advantage? The advantage is it is based on the similar listed company. So this is one of the advantage that we can use the PE ratio. If you don't have the PE ratio, then we can use the listed companies, similar listed companies PE ratio. Okay, this impacts our includes impact of brand. So this PE ratio not only includes all the assets, but also includes the intangible assets as well, because the investors, the shareholders who wants to invest in our business, so those shareholders also consider the intangible assets as well while investing. But in case of net assets method, this net assets method don't consider the intangible assets. But in PE ratio, investors know that this company is a service based company and has the intangible assets like skilled employees. So they want to pay higher than their earning. So this PE ratio includes the brand, that is the intangible asset. So we include the intangible assets value in this method as well. Actually, we don't include, but the shareholders consider this intangible asset while 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 paying for the earnings of in proportion to earnings. Okay, because next is the widely used and accepted. So it is well known and easy to understand. So the disadvantage is that it relies on others PE ratio. So it relies on someone else PE ratio. So that needs to be adjusted. So another disadvantage is that we cannot get if you don't have the disadvantage is that if you don't have the PE ratio of our company, then we have to use the similar companies ratio, and that might not be. So the disadvantage is that we relies on the proxy PE. company ratio. So this is the disadvantage, that we rely on the someone else PE ratio, not our company, and that needs to be adjusted. So another work we have to do. So that's the disadvantage. And another disadvantage is that we are using the historical value. This is the historical earnings. Earnings are the earnings value. Earning value is the value that we earned during the year. So this is the historical value, not the future value. So it is not good, because the decision cannot be taken based on the historical figures. So this is one of the disadvantage. Next we have the question for this. Let's calculate the valuation of PE basis. Calculate evaluation of PE basis of AGB and briefly comment on your answer. You have to value the business based on PE basis, based on PE, and you have to comment. Okay. So earning based valuation for AJB, PE ratio of similar companies. We calculated this. The similar PE company ratio is 15. So this is the 15, and after applying, we have the 15 multiplied the earning. We have the earning, the total earning. The total earning is, the current year is 21.9. So when we multiplied it, so we will get the total value of the company, that is 328 million. So if you want to calculate the value per share, then we know that this the value number of shares in the company is 40 million. Then we have to divide it by 40 million, and we will get 8.2 million per share is the value of the company. Our adjustment would have to be made for differences between two companies, but we need to adjust the PE ratio. So AJB is not a listed company, so our company is not listed. So we have to lower down the PE ratio, because our shares are not marketable. Our shares are not marketable enough, but the listed company shares are freely marketable in the stock market. So if the shares are marketable in the stock market, so shareholders would pay the premium for the marketability. But as our shares are not marketable, so definitely our price will be lower than the listed company. So our P ratio will be lower as well. So due to investors paying premium for the shares in listed company due to increased marketability, hence we need to revise the valuation down. Okay. And for the growth prospect in each company, so we also have to consider the growth prospect in each company and the gearing. If the growth prospect of the company is higher in this listed company, then and our company is lower, then we have to lower down again our PE ratio as well. So if our company has high has for example lower gearing, which means we have the lower debt, so we have to increase our share price. If our gearing is higher, then the investors don't invest in our companies, and they want higher. They they afraid to invest, they reluctant to invest in our company, and so the price will be lower. So we have to reduce our company share price and lower down our PE. So all those differences could cause the PE valuation incorrect. So these differences, due to these differences, the PE will be different for these companies. Okay. Okay, so the next is the earning yield. So earning yield is the less common method used in the valuation of a business. So it is not commonly used method, and also it is also it give essentially the same valuation. So it give the same value like the PE method. Okay, and it is the inverse of the PE. So what is the formula for the PE? We take the price per share and the earning per share, right? So this is this inverse, the earning yield is the inverse. You have to take the EPS here in the numerator, and in the denominator you have to take the price. Okay, so it is the inverse. So it tells that how much is the earning in relation to the price of the share. So it tells how many times the shareholders, how many times the so it tells us the how many times the company is generating income in terms of their share price. Okay, so in order to calculate the value of the company, like for the value per share, we have to multiply it by EPS 1 divided by earning yield. So because it is inverse, so we have to inverse this ratio in order to calculate the share price. Like you have the earning yield, so this is the earning yield. So we have the EPS divided by market price per share. So let's do it this way. You have the EPS divide 1 divide EPS divide MPS. When you solve this will go above this EPS multiplied MPS divided by EPS. Okay, so this MPS and EPS is actually the P ratio, right? The price and the earning. So actually you are multiplying the EPS by the PE ratio. So the value will be same, and you will calculate the value per share. The value, if you want to calculate the total value of the company, then you have to multiply this by the total earning of the company. So we can incorporate earning growth. If you want to incorporate the earning growth in this formula, then you can incorporate the growth as well. So 1 plus G, and you have to 1 minus the growth rate. In any formula, you have to incorporate growth, then you have to just multiply the numerator by this, and you have to deduct the growth. Okay, then you can incorporate the growth. So here we have the question. The company A has the earning, that is the total earning, and we have the growth is given here, and a similar listed company's earning yield is given 12.5%. So if without considering the growth, we can calculate this like 300 by 1 divide earning yield is 0.125. So you will get the same answer, that is 300. Okay, so if you want to incorporate the growth, then you have to multiply it by the numerator 1.03, the growth rate, and you have to deduct the growth rate, then you will get the answer this. Okay, the answer you will get, the same answer you will get in case of earning yield and the PE ratio. Okay, so now we have the cash flow based methods, and these cash flow based methods are useful for valuing the ongoing business. Okay, so in cash flow based methods, we have two methods. First is dividend valuation method, and the next is the discounted cash flow method. Okay, in dividend valuation method, it is useful for minority shareholding, and it is for shareholding controlling minority shareholding, controlling shareholding. If you want to acquire the minority shareholding in any company, then it is to be valued using dividend valuation method. But if you want to acquire the controlling shareholding in a company, then that must be valued using discounted cash flow based method. Okay, so minority shareholding is less than if you acquire less than 50%. So you don't get the control. But if you acquire more than 50% shares of a company, then you get control over the business. Okay, so these methods are useful based depend upon the controlling interest. Okay, and these method useful for valuing the ongoing business. Okay, the first is the dividend valuation based method, more suitable for minority shareholding because minority shareholders cannot change strategy and payout policy. So this dividend valuation method uh, is useful for minority shareholding because minority shareholders cannot change the strategy of dividend payout, okay, and can realistically expect to receive only the dividends. So they can only receive the dividend and cannot change the dividend even and eventual sale proceeds determined by those in the control. Okay, so the dividend valuation method, the formula for this is P0, that is the price, you will get the value per share, this is the value per share or the price, equal dividend that is paid now, and 1 plus G, that is the growth rate in the dividend. RE is the cost of equity minus the growth rate of the dividend. Okay, so dividend valuation method calculate the X dividend price. So this price, that is the value per share we will get, is the X dividend price. If shares, but if the share is about to pay a dividend, but if the dividend is about to be paid, then this price will become dividend. Okay, and this price will become dividend. So what is the advantage? The advantage of this is that it includes growth. Yes, it includes growth, and it is linked to shareholders value because it considers the dividend. So it is linked to shareholders value. It is useful for valuing the minority holdings. Yes, is assume that constant dividend growth rate. So this growth rate will be constant over the years. So for example, from 1 to 5 years we are considering, so this growth rate will be 5%. So for example, this is 7%, so 7% per annum from 1 to 5 years. But you know that this dividend growth cannot be 7%. It can be higher or it can be lower because it depends upon the company's policy, and it depends upon the company ability to generate the profit. If the company has higher profit, and it can pay the higher growth, but if the company don't have higher profit, then it can also lower down the dividend growth rate. But here we assume that the dividend growth rate will be constant every year, like 7%. Okay, assume that the growth rate is lower than the shareholder return. So this growth rate will be lower than the cost of equity. So for example, the cost of equity is 12%. So we only consider that this growth rate will be only the 7%, because if this is 15% here, then we will get the answer in negative. We will get answer the value of share in negative. So, and you know that the value of the value of company cannot be in the negative. Okay, cannot be the negative. Not all companies pay dividend. If any company who don't pay dividend, so we cannot calculate calculate the value of that company based on this method. So this is the result. Next, we have the discounted cash flow method. This is the maximum value of a company. This is the maximum value of a company and is appropriate for controlling interest. If you want to acquire the controlling shareholding in a company greater than more than 50%, if you want to acquire more than 50% shares of a company, then you will get the control over the business, and you can also uh, like you can also take the decisions like reinvestment, acquisition, and the you can also control over the policies. Okay, so for this calculation we have to take the cash flows. Which cash flow we have to take? For this, we cash flow we take is after interest and tax. If we take the cash flow after interest and tax, we will get the value of equity, because this cash flow, this after interest and tax, belongs to whom? This cash flow is belongs to equity shareholders. This cash flow belongs to equity shareholders. So we have to discount this cash flow with the equity, cost of equity, and we get the value of equity. But here this cash flow before interest, this cash flow before interest, the profit before interest or cash flow before interest belongs to debt holders. Okay, and this cash flow after tax belongs to equity shareholders. So cash flow before interest but after tax belongs to debt and equity holders. And when you divide this by WACC, which includes equity and the debt, WACC is the weighted average of equity and debt. So when we discount this cash flow by the WACC rate, then you will get the value of equity and the debt. Okay. So the advantage of this is that, so if you want to calculate the value of that equity, then you have to deduct the value of the debt from here. Okay. So like you have to deduct this value from here. Okay. Advantage can be used to value part of a company. This can be used to value the part of a company. Yes, the controlling stake is useful for valuing the controlling stake. Use cash flow, not the profit. So this method use cash flow, which is difficult to manipulate, difficult to manipulate by accounting policies. And profit can be easily manipulated, but cash flow cannot be manipulated by accounting policy. So this is the good thing in this method. Okay, but disadvantage is that it relies on both cash flow and discount rate, which is estimated, which is the estimates. So this cash flow is the future estimate. This cash flow is the future estimate. We are estimating that these cash flow, for example, 1000 we will get every year. But you know that future is uncertain. Future is uncertain. And you cannot say that you every year you will get $1000 as a cash flow. So these are only the estimates and may not get in reality in. Okay, and this discount rate is this discount rate also may not be available, and this discount rate is the estimate. Next is the difficult in choosing the time horizon. So another difficulty is that how many years we will get this cash flow, whether we will get for the 5 years this 1000, or we will get it infinity, or we will get it for 50 years. So this time horizon is uncertain, one of the difficulties we face while calculating. Okay, Next is the assume that discount rate tax and inflation will be constant, but in reality tax rate change every year, okay, and the inflation also change. So we cannot say that it will be constant every year. Okay. Next we have the question, and have to calculate this question is based on the cash flow based method. You have to calculate the discounted cash flow valuation of AGB, and you have to comment on your answer. Okay, so now we have some questions for the dividend valuation method and the discounted cash flow method. Okay, so the first question is about calculate the discounted cash flow. It is based on cash flow method, and calculate the discounted cash flow valuation of AJB, and briefly comment on your answer. Okay, so we need to calculate the first free cash flow. We need to calculate the free cash flow, then we will calculate the value of that. Okay, so the cash flow is how much? So the cash flow is this 22 for x1, x2, x3, x4 and x5. 22, 17, 21. Is we have to take the future cash flow. So this is the current year, x3 is the current year, and x4, x5 is the future year. We take the future cash flow, which is 27.8 and 34.6. Okay, so 27.8, 36.34.6. Okay, and because we already deducted the depreciation, and you know that depreciation is a non-cash flow item. Okay, so we have to remove the effect of depreciation. So how can we remove? First we deducted the depreciation before the PAT, so now we have to add back the depreciation. Okay, so now we have to add back the depreciation. Okay, next is we have the capital expenditure from the cash flow, and capital expenditure is same as depreciation value. It is given here that the capital expenditure is assumed to be equal to depreciation. Okay, so now we have to deduct the capital expenditure from it. Okay, now we have the free cash flow, which is 27.8 and 34.6. Now this cash flow will grow at 2%. So 34.6 will grow at 2%. So this will be 35.3 for 20x6. Okay, and from 20x6 this will grow to infinity at 2%. Okay, this will grow to in the 20x7 it will be 35.3 multiplied 1.02. How much? 3 multiplied 1.02. Well, okay, so this will grow at 2% every year. At how many years? For how many years? Infinity. Okay, up to infinity this will grow. Okay, so we can calculate this value instead of calculating every year. We can calculate this, how much cash flow we can get throughout the whole life or the infinity. We can get this is the 20x6, and we have to divide it by the cost of equity. This is the cost of equity, This is the cost of equity value, which is 11% here after tax. Okay, which is cost of equity, and we have to reduce the growth rate, and then we will get the cash flow till perpetuity value. Okay, this is the value of cash flow, free cash flow till perpetuity, infinity. Okay, this is the total amount we will receive till perpetuity. Okay, so now 20x for 5, 20x 6 to infinity. How much we will get? This amount we will get. Okay, this is for the x5, x6, and till perpetuity we will get this. Now we have to discount this for the 11%. So discount rate for the 11 at 11% is 19.910, and for the second year this, and for the we have to consider this discounted cash flow here. So now we will get the present value, and this will be the total value of the company. Now we can divide it by 71.4 divided by 40. We will get the number of value per share. Okay, 85. This is the value per share. Next we have the dividend valuation method. In this method we will calculate the value of company using dividend valuation method. Okay, so first we have to calculate the growth. So growth, and the formula for this method is d1 ke, or I can say that the p0, this is the formula, d0 1 plus g ke, that is cost of equity minus g. Okay, so now the d0 is given. D0 is D0 is the current dividend. D0 is the current dividend. How much is the current dividend? This is the current year 20x3, and we have the dividend here 11.2. 11.2 and multiplied 1 point. We need growth rate for this. Okay, so what is the cost of equity? Cost of equity is this, and now we need growth rate. Okay, so growth rate is right now it's 11.2, but it's okay, initially it was 10, and the current year dividend is this. How many years of accumulation? 2-year accumulation, right? 2-year accumulation. This is the how many years of accumulation? 1, 2. 2-year accumulation. Okay, so now we have to deduct -1 equal. Now we will get the growth rate as 5.8%, which is 0.058. Okay, 0.058. Okay, so now 11.2 multiplied to equal 11.8496 divided by 0.11 minus 0.2 equal 11.8496 divided 0.0 So it is the 228, right? 228 is the answer. Also, you can, this is the D0, but and we have converted it to D1. So also you can use alternatively the D1 figure. The D1 figure is 11.9, 11.9. So this 11.9 we have calculated, but you can use it from the TL. It is given here 11.9. You can directly use it here as well. Okay, so value per share is 228 divided by 5.7 per share. Okay. The assumption is that the growth rate is constant and constant cost of equity. Yes, we know this is the assumption in this formula. Okay. Next is dividend yield method. So dividend yield method is rarely tested in your exam, but if you have any questions for like this, in which dividend yield is given, dividend yield ratio is given, then you can calculate the value per share. Or if you have related information like dividend per share and market per share, then you can calculate the value or value of a company and total value of a company. Okay, so dividend yield is a price. Yield is price, that is the price, and above you have to take the dividend, and in the numerator and the denominator you have to take the price. Okay, dividend divided by market price, you will get the yield ratio. When you multiply it by dividend per share, you will get the value per share, and when you multiplied the total dividend multiplied 1 divided by dividend yield, you will get the total value of the company. Okay. Next we have the how can we value the debt. So we can value debt by its irredeemable debt. First we have the irredeemable debt, next we have redeemable debt, and then we have the preference share. Okay, then we have the efficiency, market efficiency. So let's value the debt. How can we value the debt? Irredeemable debt, it is easy to value the irredeemable debt. This is the formula for irredeemable debt is the cost of capital formula for cost of, let's understand the cost of equity, cost of debt, sorry, cost of debt. Formula of irredeemable debt is I divided by the price. Okay, so now you have to inverse this. So this will be I divided by the cost of debt. So this will be the value for the irredeemable debt. Okay, Hammer company has nominal value which is 6% irredeemable debt, and Hammer company debt holders required return of, this is the cost of debt. Okay, so now you have to put this formula and you will get the answer. What is the 6% of 100? You will get 6, and the cost of equity is, cost of debt is given, which is 0.07. So you get the answers. This is the value per share. Okay, value of debt. Okay, this is the value of Hamad company debt. Okay, now we have to calculate the value of redeemable debt. So redeemable debt, the value of redeemable debt can be calculated by discounting. You have to discount the future cash flow that will be received by the redeemable debt holders, interest and redemption value, their at their required rate of return. Okay, then you will get the redeemable value. So this question is, plaster company has some uh, $100 nominal value, 4% redeemable debt. This debt will be redeemed in 7 years time at 12% premium. So this will be redeemed in 7 years at 12% premium. That holders required rate of return is 10%. What is the value of plaster company redeemable debt? So from 1 to 7 years, you will get the cash flow of 4, and at the end of the 7 year, you will get the redemption value, which is 100 plus the premium. 100 plus 12, which is the premium. So you will get the 112 at the end of 7 year. Okay. Now you have to discount it. You have to discount it. Uh, you have to discount it at the 10%. This is the annuity for 7 years at 10%, and this is the discount factor at 10% for the 7 year. Okay, you will get the present value, and this is the value which is redeemable debt value. Okay, now next is the, we have to calculate the convertible debt value. It's similar to redeemable debt value, however it is similar to this question, but it is similar to redeemable debt. However, at the end of debt life it can be either. However, the difference is that you can either redeem or convert it into shares. You can redeem or convert it into shares. This is the debt holder's decision, and will depend upon the value of shares compared to the redemption value. So out of which the highest value will be chosen by the convertible debt holders. Okay, the market value of convertible is the higher of floor value and conversion value. Floor value and the conversion value. Okay, the floor value is market value without conversion option, and so out of these, the floor value which is without conversion value, and this is the with conversion value. So out of these, whichever is higher, the debt holder will choose that. Okay, so floor value is market value of debt without conversion option, and conversion value is market value with conversion option. And what is the conversion premium? Conversion premium is the difference between them. Okay, so market value minus the conversion value. Okay, so next is this question. So the Sozlad company had some 100 million nominal value, 6% convertible debt. This debt will be redeemed in 4 years. It will be redeemed in 4 years at par or converted into 20 ordinary shares. A financial expert has forecasted that Suzlad shares, which currently valued at, this is the current share price, will be worth in 4 years. This is P0, and this is P4 after 4 years. Okay, will be redeemed after 4 years. So convertible debt holders required return is 10%. Okay, this is the KD. In 4 years time, the debt holders can either redeem at 100 or convert into shares, which is 20 multiplied the 4 years after 4 year price, which is the 5.18. So this will be the value if you convert it into shares. But if you take the debt as the redemption, then if you redeem your redemption, if you redeem your debt, then you will get this as the, this is the, what is the market value of convertible debt. Okay, and next is the floor value. So in market value, we'll consider the highest. Okay, so highest is the, can either redeem at 100, which is 100 nominal value, or you can get the 102. So in this market value we will get this. Okay, we will take this. This is the interest you will get for 1 to 4 years is 6%, and you discount it at the cost of debt, which is 10, and this is the annuity value, annuity factor, and you will get the present value. When you discount it by 10% at discount rate, you will get the present value. This is the market value. But if you, the only difference is this, here you will get the 100, you will get the market, which is, here you will convert it into shares, which is the highest value. So you will choose the highest value, and here you convert it into debt. Okay, so this is the answer here. So the floor value is this is the floor value, this is the market value, and the difference is the premium. Okay, so finally we can also calculate the conversion premium, which is the difference between current value and the convertible debt, and the conversion premium of the shares. This is the extra value in holding the convertible debt rather than equivalent shares. So this premium, this conversion premium is the benefit. This conversion premium is the 68.9 minus 20 point. Conversion premium is this market value, and this, if it is converted at current price. If 20 shares converted at 20 at current price, if these shares are converted at okay, so this difference is the conversion premium you will get. This conversion premium is the benefit that you will get in case of convertible debt. Okay, this is the extra benefit. Okay, next we have the preference shares. Preference share is same as irredeemable debt. Okay, so the calculation will be similar, just you need to do the dividend instead of interest. So preference shares are similar to ordinary shares, except that the dividend is constant and there is no growth. Okay, this preference shares is same as dividend, the characteristics, but the constant dividend instead of the growth and the dividend, there is no there is no residual right. Instead they will get the constant dividend like debt. Okay, so this is also considered as irredeemable debt. Thus the value of preference share can be calculated by using the following formula. Okay, so this is the formula for the calculation. Resolute company has paid a dividend which is 20 cents to its preference share. The preference share required return is 11%. What is the value of Resolute company preference share? So it is very easy. It's very easy. You need to calculate. You need to put this dividend and the cost of shareholders, which is 11%, and you will get the 1.82. Okay, 0.82 and the preference share capital. Value of preference share capital is $1.82. Next we have the market efficiency. For this market efficiency, we have to first understand the efficient market, inefficient market, and perfect market, and then we have the levels of efficiency. The levels are weak form efficiency, semi-strong form, strong form efficiency. Okay, then we have very different concept here, this which is behavioral finance. It means why why the investors behave irrationally. Why investors behave irrationally means without without knowledgeable decision. So why investors take irrational decisions? So there are some reasons, which is the herding, stock market bubble, noise traders, loss aversion, and momentum. Okay, these are the reasons. Then we have the practical consideration of valuation of shares. Previously, we understand the theoretical aspects, how to value the shares of a company, the debt of a company, how to value the business. Now we are considering the practical aspects. Okay, and here we have the marketability, liquidity of shares, the first concept, the availability of information, and the equilibrium price. Okay, so let's start with the first, the market efficiency. So we have different types of market: efficient, inefficient, and perfect market. And based on that, we have different levels, which is weak, semi-strong, and strong. Okay, market efficiency. So before we understand the market efficiency, let's first understand different types of market. Different types of market, which is inefficient, efficient, and the perfect market. Okay, so in inefficient market is one which value securities is one in which value of security is not accurate. It means value of security is not accurate reflection of information. It means the information are not truly reflected in this market. Okay, in inefficient market, it means that if the information is not reflected accurately, it means the price will be overpriced or the underpriced, okay, in the stock market. But in efficient market price, the in which security prices change quickly, in which the security prices change quickly to reflect the all available information. So the available information will quickly reflected. But in inefficient market, the security prices, the information will not be, the security price is not reflection of the information. Okay, so in an efficient market, new information quickly and rationally incorporated in the share price in an unbiased way. But what does it quickly mean? So to understand this quickly the meaning, we have to understand the three levels of that: strong form, semi-strong form, and the strong, semi-strong form, and the sorry the weak form, strong form, and the semi strong form efficiency. Okay, so in efficient market, the new information quickly incorporated, and this quick means it is in minutes. So you have to understand this quick means in minutes, not in days, right? And we have next is the perfect market. So perfect market, the share price change in share price, change in information. So change in share price, which is instant. But here the change in information will take some time, which is might be some few minutes. But here the new information, the change in new information will not reflected in the in the share price. Okay, but it is here in the efficient market, it is reflected in the minutes. But in perfect market, it is reflected instantly in the share price. Okay, the new information. Now we need an efficient stock market. Why we need the efficient market? We need the efficient market so that the investor has confidence, so that investors confidence remain in the stock market. So to ensure the investors confidence, we need the efficient stock market. Okay, and the another reason is the directors performance in the share price. So So if the share price is if the higher share price if the higher share price, or it is increase in share price, or we have the higher share price. What does higher share price indicate? The higher share price indicate that directors is performing very well. Because of directors performance, the business is performing well, and when the business perform well, the share price will go up. Okay, so for these reasons we need the efficient market, so that we can identify whether the investors confidence in the market and whether the directors has good performance, because we can identify this by the share price. Okay, next we have the levels of efficiency, the degree of the word interpretation of the word quickly. So there are three levels: the degree of efficiency, the weak form, the semi-strong form, and the strong form. So in weak form efficiency, the share price reflect all information from the past changes. So weak form efficiency has past information. So you cannot beat the market. So you cannot beat the market by technical analysis. So you cannot make higher return than average return. You cannot make higher return than the average return or market return by just studying the past share price. Okay, so if you are studying the past share price and doing the technical analysis, and you are considering that you will get gain out of this analysis, so this is not possible because the share price already reflect this past information. Okay, but in semi-strong we have the past information plus the published information as well. Okay, published information, any publicly available current information. So we have the past information and any publicly published current information. Published current information. Okay, so the market cannot be beaten. So market, you cannot make a higher return than the market return, because the news or published accounts or the past information is already reflected in the share price. So major stock market are close to semi-strong form efficiency. So mostly markets are have this efficiency, the semi-strong efficiency. So this is tested by monitoring the speed with which information react to publicly available information. So you can test this efficiency, which efficiency you have. You can test this by identifying how is the speed. So if your speed is higher, then you have the strong form efficiency. If you have the lower, then you have semi-strong and have the okay. So this semi-strong efficiency, so this efficiency can be tested by monitoring the speed by which the information change and the share price change. So by doing the speed analysis of the information change in information and the change in share price, we can test the efficiency. Okay, so next is the strong form efficiency. The share price reflect all information which is available, past information plus published current information. Okay, and any inside information. So even if you have the insider information, you cannot make profit. Okay, so all information are reflected in the share price. Hence, market cannot be beaten using even the insider information. So this is the strong form efficiency. Okay, first we have to also, the most important thing is that this has the past information. It reflects the past information. This reflects past information. Okay, this has the past information. This has past plus present, current. Okay, this has the past plus present plus the future information. Okay, so we have, in this we have only the past information. In this we have the past and present information. In this we have past, present plus the future information, which is not available now, but it will be available after some time when it is publicly available, because right now it is inside information. So one more thing is that the form of efficiency is cumulative. So the market is semi-strong, it also has a weak form efficiency as well. So if this market is semi-strong, so it means that it is weak form as well. So you know that this is strong, semi-strong. So this has the weak form efficiency as well. This past information is weak form efficiency as well. Okay, so when you have the weak form, when you have the strong form, when you have the strong form, this strong form also has the semi-strong form efficiency as well. Okay, so this has the past information as well, this has the past plus present, and this has the past plus present as well. Okay, so you have to understand that this is the cumulative. These 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 efficiency, the form of efficiency, are cumulative. Okay, we always assume that the investors make rational decisions. It means that they always make the decisions after careful analysis. Okay, but in reality, investors don't make the rational, always don't make the rational decisions, but they sometimes make the irrational decisions as well. So this behavior is explained by this behavioral finance theory. Okay, in this theory we will understand not only the why the investors behave irrational decisions, why the investors behave irrational decisions, but also understand why this is happening, because we are also understanding the reason behind this, because we will understand the reason behind the irrational decisions as well. Okay, so behavioral finance attempts to explain why investors make irrational decision, which is without knowledge or without careful analysis. Okay, why investors make without careful analysis decision, without thinking any thought process. So they make irrational decisions because a consequence of inefficient market believe that true share price would only rise and fall in response to good and bad news of the company. So in efficient market hypothesis, we assume that the share price only rise and fall due to bad news or good news. But in real life, this is not the case. But in real life, what is happened that it is about the movement. It is about the movement. There is often a large movement in share value that are unrelated to these news, where investors appear to act irrationally without analysis, without careful thinking, without think or analysis. They make the decisions. But why they make this type of decisions? Because these are the reasons. Because it is because of herding, because of bubble, because of noise traders, because of loss aversion, because of momentum effect. So let's first understand the herding. Okay, let's understand the reason number one, the herding. Herding is when a group of individuals follow each other. Okay, like sheep herd, when one sheep when one ship follow one another without any thinking. Okay, and in investors point, in investors, when investors follow each other without taking their own decisions. Okay, without taking their own decisions, this is herding. So this is when investors buy and sell. Investors buy and sell because other investors, they are following others and have already done so, because they are because other investors already done the buying and selling of that share. Okay, this may stem from a desire to confirm, or because they lack the confidence to make their own decision. Why they make these type of decisions? Because they have lack of confidence, because they have lack of confidence in their own decisions or judgment. That's why they are following the other investors or the leaders. Okay, the more people that follow the herd, when more and more people follow the herd, the more likely the people will join. Okay, then telling the feeling the decision, then they feel that if the large number of people are buying these shares, they feel that if the large number of people are buying that share, which means that it has some value, it has some value. That's why they are buying these shares. Okay, so another is when the this ship herd, or I in this ship herd, or this is herding. So when this herd, this momentum continue. Okay, so when the investors follow others, when they follow others and make the herding decisions, so this will create a bubble in the market. Okay, and this bubble will burst one day. And where there is a herd instinct, when there is a herd instinct, this lead to sharp rise in the value of shares, and this increase in share price, this lead to share price will increase, and this share price will increase at a unsustainable, at the highest level, at the highest level. So this share price will go at highest level, and after that this share price break. Okay, this share price will break, and this is bubble burst. Okay, also the example is not just applied to shares. Housing prices in US rose massively in week 20 and then reached to a peak, and that decline, which is 40% decline. Can you imagine that 40% decline in the in the prices of houses? So this bubble burst, and the sharp decline in the prices, and this bubble burst one day. Okay, so next is the noise traders. Noise traders are those who do not base their decisions on professional analysis, who make poor time decisions and follow the rumors and trends. So noise traders are those traders who base their decisions based on the noise, that rumors. So if the noise is that this company will do good in the future, if this company has good future, this company has good future, so they will invest in that company. If they think that this company is bad, then they don't invest in that company. So they are following the rumors, don't follow their own analysis. So that is noise traders. Another is loss aversion. When you take these short-term decisions, instead of taking the long-term decisions. In short-term, the prices in the short-term decisions, you take short-term decisions, and you know that in the short-term, the prices, the share price may be high. The share price may be high, but in the long term, may be low or high. So in loss aversion, the investors make short-term decisions. Short-term decisions are based on avoiding the risk. Why they are making the short-term decision? They are making the short-term decision to avoid the risk. So if this share price is very 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 low, the share price is very low, then they will buy that and sell that in the. So in loss aversion, where investors avoid investment which has a risk of making losses, so those companies who make loss in the short term, right now, if this company is making loss, so like initially, like startup companies, they avoid investing in startup companies who initially make loss, but after in the long term that make big profit, like Zomato. Okay, so in the startup companies, they avoid because of short term, because in the short term the Zomato is making loss, but in the long term it is making now profits. Okay, but they avoid investing in startup companies because they are making loss. Instead they make their decisions based on the capital gain. This lead to choosing investment that are safe but earning low. So that's why they are earning low, because these companies, those stable companies are less less capital gain, but this more capital gain, because the share price will increase very high in these startup companies. But here, stable companies only has very low capital gain, because their shares do not fluctuate very frequently. Also, they pay very low dividend. Okay, that's why they don't make much profit. Next is momentum effect. Once a trend is seen in share price, the market may become optimistic and pessimistic. Optimistic is bull and this is bear, and this will stimulate the further investment and lead to trend continue. So momentum effect is that when you know that when the share price increase, the bull trend will continue, and bull trend will continue for a period of time, for 6 months, for 5 months or 3 months. Okay, once a trend is seen in share price, the market will become optimistic, because people believe that when the share price is increasing, then it will increase in the future as well. But if the share price will decrease, it will decrease in the future as well. So they are optimistic and pessimistic. And you know that when the bull trend continue, it will continue for the few months. And when the bear trend continue, this will continue for the few months as well. So investors believe that the share price will, when the rise share price, it will continue rise in the future, but when it decrease, it will continue decrease in the future, and this will lead to further investment or selling in the shares. Okay. Before we move ahead, let's first understand the some of the key terms, which is market paradox and the clientele effect. In market paradox, the investors believe that market are inefficient, because they believe market is inefficient because investors believe market are if investors if investors believe market are efficient, then there is no point in trading. So let's first understand what is inefficient and efficient market. So efficient market is where the price is up to date, the true and fair price. And inefficient market, in this market, the prices are not accurate and not up to date. Okay, so if the investors believe that the market is efficient, which means that their prices are true. If their prices are true, if the actual value of the prices is 100, and they are also, the market price is also the 100, so there is no gain by selling and buying this price. Okay, but the actual price, the intrinsic price is actually the actual price. So this is the actual price. If the actual price is 100, but the market price, that is in the current market price, is, let's for example, the 70, which is lower. So they will buy at 70 and they will sell at 100 after some time. So then they will make the profit. But if the case that market is efficient, which means that this actual price and the market price will be same, because the inefficient market, the market price reflect the true price. So there is no gain in that, no profit, no loss. Okay, so that's why investors always believe that the market is inefficient. That's why the only way they will invest, the only reason they will invest, because they will only invest if they assume that the market is inefficient. Okay, so next is clientele effect. Clientele effect says that investors, those investors are the clients who buy shares that suit their needs. So investors only buy those shares who suit their needs. So if an investor is pension fund, so they have to pay the regular pension, so they only invest in those shares which give the regular dividend, so that they can pay the regular pension. Okay, so this make a high risky investor may invest in shares that offer low dividend but huge upside of capital gain. A high risk investor may invest in, but on the other case, if a risk seeker investor, the risk seeker investor invest in low dividend, they will get the lower dividend or not no dividend, but they are expecting that they will get a capital gain, which is very big amount. Okay, which will be a very big amount. So the risk seeker invest in low dividend shares, but wants to expect that the shares will get a higher dividend. Okay. So we already studied the methods, how to value the shares and the business, but here we understand the practical how practically the shares and businesses are valued. So it depends on the marketability and liquidity. For example, in a listed company, so the in a listed company, the shares are highly marketable. But in unlisted, the shares are not marketable. Not okay. So the shares in a private company is often valued by using the measurables based on the fair share prices of the similar listed company. And you know that when you value the private company or unlisted company, you take the PE ratio, of listed company. Okay, you take the PE ratio of listed company, then you value that company. Okay, so in the PE ratio we have the price divided by the earning per share, price per share, and divided by the earning per share. So this price depends upon the marketability. If the shares of a company is highly marketable, if the shares of a company is highly marketable, which means in case of listed companies, the shares are highly marketable, which means that the seller and buyer can easily sell their shares and buy the shares. Okay, so they are highly marketable. If they are highly marketable, so the buyer will ready to pay the higher prices. So they will ready to pay the higher prices. If they pay the higher prices, so this PE ratio will rise. This PE ratio will rise. It means this will be higher for the listed company, but this must not be higher for the unlisted company, because these are not the marketable, because the shares of unlisted companies are not marketable. Okay, however, buying a share in unlisted is more of a gamble, as the shares cannot be easily sold. Because the shares cannot be easily sold, this is why values given in methods such as price earning ratio and earning yield are often downgraded. That's why the P ratio, the P that's why the P ratio of the unlisted company, because P method, when we value the companies, unlisted companies, based on the P ratio method, then this value will be low because it is not marketable and it is downgraded. Okay, that's why values given by methods such as price earning ratio and earning yield are often downgraded. Next is available information. In listed companies, they have the available information publicly available information. Publicly available information is publicly available. In unlisted company, not. So in listed companies, the information is publicly available, but in unlisted companies, the information is not publicly available. So let's read this. We discussed that the above the importance of information concerning a company being fully available if the shares is to be fairly priced. If we discussed about the importance of information concerning a company being fully available if shares are to be fairly priced. We discussed that the importance of information concerning a company being fully available if shares are to be fairly priced. So in order to fairly priced the shares of a company, we should have the publicly available information, which is only possible in case of listed company. So in unlisted companies, the shares of the price are not fairly. So in the unlisted companies, the shares are not fair. Okay, so information may be less readily available for the number of reasons, such as weaker control environment and unaudited financial statement. Listed companies financial statement are not audited, and fewer compliance regulations, no tradition of share information, so channels of communication not set up, and less detailed record keeping. Okay, that's why their share price also undervalued. Undervalued. Okay, so unlisted companies also the valuation will be downgraded because of availability of information. Okay, so equilibrium price. So equilibrium is stable price. So when we value any companies, we have to take the stable price of the other company. So which means that we have to take the stable PE ratio of any companies. How can a PE ratio be stable if the share price of a company is stable? Okay, so in practice, I discussed the market price shows sudden price fluctuation that cannot be explained simply by the information being newly released. If share price are highly volatile, if the share price are highly volatile, it is considered not in equilibrium. So these prices will not be equilibrium. Okay, if any company share price volatile, then it is not equilibrium. If the share price is not volatile, if it is stable, then it is equilibrium price. Okay, and we have to use the stable companies and their stable PE ratio. Okay, so that our values will be accurate. So prices that provide the valuation for the unlisted companies need to be equilibrium, which obtain meaningful value. So if only similar company exists, then the share price is not equilibrium, and any share price category must be treated with caution. Okay. Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.